Today, we process close to 5,000 deals a year.
Oh my God. Okay.
Right? Yeah. The genesis of Chiratae Sonic, where we said, okay, up to $500,000 we can invest in, and we get back to companies within a 48-hour window to say that, okay, we are interested, we want to move forward, and so on and so forth. I think anybody who raises capital, I think today understands that he will have to provide exits for the investors, whether it's the angel investor or early stage investors, and so on and so forth, right?
Hi everyone, in this episode I get a chance to speak with Ranjith Menon. Ranjith is a managing director at Chiratae Ventures. Ranjith has had a front row seat in the evolution of the Indian VC ecosystem for about 2 decades now. He shares a perspective on how the founder landscape has shifted from, let's say, seasoned corporate executives running companies to a much more younger, bolder, and more globally minded generation of entrepreneurs. We also dive into how VC strategies have matured, moving from broad bets across industries to a more specialized sector-focused investments. We also discuss the rise of domestic capital and how it's fueling the next wave of innovation in India. If you're a founder, an investor, or just curious about where India's startup ecosystem is heading to, this episode should be really helpful for you. With that, my friends, Ranjith Menon.
So you've been in the venture space for about, I'm guessing 17 to 18 years, I think almost 2 decades now. Can you walk us through the changes that you have seen maybe while entering the field, and today, how has the landscape evolved over the last 2 decades as the country also has progressed? Bangalore also has become sort of like the Silicon Valley of India. What are your impressions? What are initial thoughts? And maybe we can pick it up from there.
Sure. So we started investing in 2006, right? Now, one of the biggest changes, right, was that the entrepreneurs that I used to meet was significantly elder to me. They're older to me in that sense. Largely people coming from services and not so much products and so on and so forth. So over the last 18 years, I've grown older. The average age of the founder that we're backing today is 28, 29. So it's significantly younger population. There's a big shift in terms of the age profile of the people that I used to meet at that point in time to what I see today.
So have older people started taking less risk over the years, or has the younger?
No, I think it's the younger population wanting to do a little bit more better, right? I think the awareness levels of the younger population are significantly high. Their understanding of what's happening globally is extremely high compared to what they knew up with 18, 20 years back. So I think all of that has leveled the field in terms of, experience being the biggest driver to more understanding of what is important and what can be done. And the risk-taking ability of the younger population is significantly higher. So I think that shift is very, very clear in the last 20 years. I think the ecosystem was very, very new when we started. I think so we ourselves, kind of grown along with the ecosystem in the last 20 years from a venture perspective.
So if you go back 20 years, it should be like 2006, 2007, if I'm not wrong. Like I can't even, I don't even know if there were like enough companies to fund. Was that a challenge?
Oh, it was. We would look at, a few hundred deals, opportunities, and those were very largely services driven. If you look at that point in time, there were large businesses in Infosys, Wipros of the world, and the services business, people coming out of services business and trying to do something similar, right? Product stories were very, very few. Internet was just about taking off. So there were not too many opportunities, really think about it from that standpoint. But if you think about today, I mean, the world is very, very significantly different in terms of where the tech is, where the opportunities are, and it's globally more flatter in that sense. Just to give you some perspective here, today we process close to 5,000 deals a year.
Oh my God. Okay.
Right? Yeah. And that's a shift. That's a shift.
Understood. Has what you were looking for in companies back in 06, 07, at least has that thread remained consistent, or as the nature of the beast has changed, is what you're looking for in the initial stages, has that changed over the years? Or
No, so if you really think about how we started, I mean, our initial fundamental premise has been that technology is going to be the driver for doing good, right? So we're a tech-focused fund. So everything that we do will want something to do with technology or technology-enabled products, services, and so on and so forth. I think that tenet has not changed for us from our standpoint, right? So that's very important to understand. We continue to remain a tech-focused fund, looking at disruptive ideas that can change the world, that could potentially come from here and go global. I think that's fundamentally, there's no shift in that hypothesis. But over the years, there's significant changes in terms of how our approach has changed with the market, because the market has also changed. Today, we have very sector-focused people at the fund looking at whether it's healthcare, whether it's consumer, whether it is SaaS, whether it is fintech, and so on and so forth. So deep tech is again emerging, and these sectors also are constantly emerging. Today, deep tech I think is an important area for us as we look at Fund 5. So that is one significant change in terms of how we've approached the market and the dynamics that we see there. The second one is the portfolio construct. Our portfolio construct, building the portfolio construct has become extremely sophisticated, right? In terms of how we allocate, how much should go into seed, how much go into early stage, how much goes into growth. And so there is a very sophisticated thinking process in terms of how we build and construct that portfolio.
When you started, was it only seed or did you have like...
No, I think I don't think the market also had that level of sophistication. So we were a generalist fund within the tech space, right? And so anything to do with tech, we would look at.
You'll take anything you get?
No, not anything that we get. We did have an investment thesis that we would follow in terms of what sectors and what we want to do. But that has gotten more and more sophisticated over the last 20 years. And depth in some of those sectors today is a lot more than what was there. Today, consumer and internet is extremely deep, right? Which was not the case at that point in time. So I think those sectors have emerged. It's gotten deeper. So our sophistication and how we approach those sectors have also changed, right? The last bit is also the fact that, venture business is just not about making investments. It's also about returning capital back to our investors. And as we move from one fund to another, I think not just the investment pieces, but also our strategy towards divestments has become extremely deliberate. And a lot of thought goes into that in terms of how do we make sure that we return capital back to our investors in a very consistent fashion. So that, because the narrative when we started in 2006 was that a lot of capital has gone in and not much has come out. And so we really wanted to make sure that we do something from our side to make sure that that narrative is changed. And we've made significant investments, both in terms of process, in terms of team, and in terms of how we approach that. So there is very significant change in that process.
I think we'll definitely delve into like exits, thinking about exits and how you talk to founders about getting an investment from getting a return from your investment. But before I go there, I'm also very curious on, I'm kind of still stuck in 06, 07 for some reason, in the sense, because I'm guessing venture was not like very popular as it is today. Like, at least what I mean by that is maybe it was not as well known, trendy with right now I feel like there is a decent sizable portion of students who may be in management or maybe in like commerce colleges who want to get into, and maybe even engineering, who want to get into like consulting and then move on to VC. How did you get into VC in 06, 07? Like,
so like you said, when there was not much known about venture capital in India, at least. I mean, outside the country, it's often very sophisticated asset class. In India, it used to be very new. I mean, the only guy I knew who knew anything about venture was the guy who offered me the job. So I really didn't know whom to go ask about this. So, but my relationship with Sudhir has been very, very good over the last many years. And so when he called me up and said, this is something interesting, I really didn't think twice, right? And I came from a very, very different background. I came from manufacturing. I spent 5-6 years designing aircraft engines for Pratt & Whitney. So it's very, very different from the venture business, right? And so when I was offered this, I looked at it as a very interesting space to be in. It was very, very new. Not many funds in the country, and not many people understood what this was. In fact, I remember my father-in-law used to be a banker. Okay, and when I told him I'm taking up this job, he told me, "Okay, great. I mean, you're giving money to companies." And he was asking me, what is the collateral? And I said, there's no collateral here, right? And it was just beyond him. He just couldn't understand how we could invest this much of our capital where there are no assets in the business, there's no collateral. And so it was really very, very new at that point in time. But I think the advantage of being early is that, we've really grown with this ecosystem, right? And then seen how this works from the very, very early days. So I think it's a great vantage point as we think about the future.
I think the concern that your father-in-law had, I think even when somebody hears about the venture business for the first time in general, I think that is like the first reaction. Like, even for me also, it took me some time to like kind of digest, like, how does it actually work?
No, but I think today it's a little bit more, understood in a much better way,
Mhm.
right? Because I mean, newspapers carry a separate sheet every day. Startups, it is a lot more glamorous to start companies, being call yourself a founder and so on and so forth. So I think it's much better today, and I think it'll only get better as we think about the future, where India is the third largest startup ecosystem, and anything to do with startups and tech, this is the place to be if you really want to be there.
So, what makes a good VC according to you? What are the skills? What kind of personality might be useful? What characteristics have you seen succeed and fail over the years?
No, see, any VC you take, he will have a portfolio of companies that have done really well. Some of them, that have not done very well, and some of them in somewhere in the middle. So I think it's very difficult to judge, if there is one single characteristic of a VC that makes him successful. There are 2-3 elements to this. One is the fact that your ability to identify good company, good founders, right? And we are an early stage focused fund, right? So to that extent, I think finding companies really early, I think that building that network where people reach out to you as they think of starting up, something I think is very important. And building that credibility is super critical for you to succeed. And that, I mean, this is a cycle, right? I mean, that happens only if when you work with founders and help them through their journey. Because some of them, like I said, the average age of the guy that we are backing today is 28, 29. So it's not like he comes with a lot of experience of building businesses. And so to that extent, I mean, how we can help him navigate that journey through those early stages will define, right? And now this could be in terms of, yeah, helping him set up processes. I mean, these are things that we do as a fund when we invest, is to set up very basic MIS, for example, right?
What is MIS?
Management information. Okay, how the business is doing, the KPIs that we need to track, set something very fundamental as that to helping him, build a team together. How can we help him win his first customer, first partnership, the next round of capital? And so there is multiple layers of, helping a business. And the last piece is also being just a sounding board to the founder, right? I mean, like I said, this is the first time possibly starting something of his own. And given the leverage that we have in terms of having seen so many portfolio companies over the many years, how do we build that trust that he can come up to you and say something, Ranjit, it's not working, right? And what do I do? And it's not like I will have the answers, right? But at least to have that conversation and see what we can do given what the situation is, I think is a significant value add, right? Those things I think will get this flywheel going, right? Which will help you. And it's a network business at the end of the day. You do well, you back both founders, they go on to build businesses. There are other people who are looking up to that founder, calling them up and saying, okay, who do you think you should be talking to? And I guess says, okay, yeah, you should talk to him, X, Y, and Z. I think that's really the way a good venture business is built.
Sorry, just to push on that thread a little bit, you spoke about founders as well. Have you seen any characteristics which stand out to you over the last 2 decades, either personality traits or characteristics which make like a good founder?
Well, there are a few things, right? I mean, they must be extremely passionate about what they're trying to do, because this is, unlike what you read in the newspapers and all the magazines and so on and so forth. This is very hard to do, and for the number of people who try, the number of people who succeed are very few, right? And then people generally know only about the ones that really succeed and not really, do not make it. So I think to that extent, it's a very hard journey. So extremely passionate about what you're trying to do. Yeah, you need to be fairly, flexible in trying to understand, because the journey from, a seed stage company to a Series A and a Series B company are very different. The challenges that you face are very different. And then as you build further, it kind of becomes completely different beast altogether, right? But in very early stages, we're looking for people who've figured something out, some insight from which they're building the product or the business or the business model and so on and so forth. It has to come from a certain level of insight that they've seen work somewhere.
But how do you validate that insight though?
No, I think again, validation at very early stages is very limited, right? I mean, it's a bet that we take on the founder, the opportunity we're going after, the size of the opportunity. And, we also look at, how comfortable he is to feedback, for example. Because like I said, these businesses, I mean, these things change over a period of time. And I'll give you an example when we invested in Mukesh Bansal of Myntra, it was a personalization platform. Right? You could print your own designs on T-shirts, mugs, and so on and so forth. The initial hypothesis was not building a fashion company. But then that is what, I mean, to Mukesh's credit, he listened to the market, he listened to all the feedback that he received from the market, from everybody else, and pivoted the business to become one of the largest fashion destinations in the country. So I think that is extremely important to kind of be open to feedback and while you build the business. I think those are the characteristics in terms of understanding and people management as you grow, right? Because at the end of the day, building a business is just not about you sitting in a room and building a product, but you got to put teams together and make that work, raise capital. Your ability to attract serious talent, capital, all of this will play a significant role. And we've seen people who are comfortable doing all of this are the ones generally kind of do well.
You spoke about this in terms of your decision making framework, in terms of valid like judging companies, but I think you're also known for I don't know throughout the fund, but about making decisions faster. Like I think on the website I saw you can sometimes often receive decisions in like 48-hour windows. Can you walk us through how you're able to make these decisions faster? This kind of reminds me of this Warren Buffett quote. I listen to a lot of Warren Buffett annual meetings. So he has this ability of making a judgment in under 5 minutes. Like when he gets a phone call in about making a decision, he by the second or third sentence he's sure whether he wants to continue that or not. So how do you think about your framework? And yeah,
Yeah, so what you're talking about is the Chiratae Sonic delivery that we have, right? Now that is, it's one of the flagship C programs that we run in the country where we get back to the founder within 48 hours. I mean, we don't invest in 48 hours, but we get back. See, it's the genesis of that is that if you look at the popular literature around VCs, you will hear that you hardly hear them getting back on anything. Right? Where to get anything back on where you stand and goes into a black hole, you don't receive a lot of feedback and so on and so forth. So we said, okay, but let's see what we can do to change that, and that's the genesis of Chiratae Sonic, where we said, okay, up to $500,000 we can invest in, and we get back to companies within a 48-hour window to say that, okay, we are interested, we want to move forward, and so on and so forth. Now, what makes it possible is a lot of preparatory work in the back end, right? Because this is focused on certain sectors, and when we launch it, there's a lot of work that goes before we launch a program as to, we define that sector, we understand what's working, uh, what are the important metrics that we need to look at in that sector. And so there's a lot of preparatory work that happens, right? So when we look at something, then we have a very good sense of, what can work, what does not work, what can potentially work, not work, and so on. So that is one. Second one, it's very standardized in terms of the term sheet that we kind of offer. It is, it's not to, we really want to keep it flexible in the sense that there's not a lot of back and forth in terms of negotiation. We really don't want to get into all of those kind of things because the focus is really on speed and moving forward. And the third part is also on the decision making process, right? The ICs are smaller, the investment committee is a smaller committee when we think about this, so we don't need to put together 20 people team to make an investment of $500 million. So those are, I think, the processes that we've developed over the last few years that help us enable to get back in a 48-hour window and run that program in a very, very effective way.
so I don't know if you're able to disclose this, but so I'm guessing at Chiratae, like GPs can like generally make a decision on investment without like there's no vote per se, because I know certain firms which have like before any investment goes through, no matter who is managing that, they'll either like have
Every investment goes through an investment committee process.
okay.
Okay, number of people on the committee can change depending on the quantum of the investment and so on and so forth. But I think, and there's a sector lead, so there is a very strong process that has been refined over the last 18-20 years for us, that we follow, and it's something that we will continue to keep evolving as time progresses. And So, but it is not that some one person can take a call, and it is a committee that is set up, and the committee sets up based on the amount of capital to be deployed, the sectors that you're doing, and so on. So,
Because I asked you that because I was recently listening to the All-In interview about Rolf Boeta. I think he's the managing partner at Sequoia. Apparently, for them, they have a committee where even if one person does not approve for that investment, they will not invest. So that's what I was kind of curious.
see, again, like I said, this has evolved for us over a period of time, and it's worked for us,
Mhm.
and we will continue to look at it. And there are different forms. There's different kinds of funds who make decision in different ways, and for us, this is what has worked. We kind of work with this.
How do you prepare? Do you have a process of, not in terms of one is just on the investment side, which you've spoken about, how you go about doing certain investments, but I'm curious as to how do you prepare. Let me take one step back in the sense that I'm trying to understand, there are people who will read about a lot of different sectors. Either they'll talk to experts in that field and then figure out, and then they will know that there is an opportunity here, and then they might go on scouting for companies. Do you have a process like that? How do you keep up with a lot that is happening? AI is one field, right? There's a lot of talk around a lot of model capabilities keep changing. So do you have a process of learning and discovering new sectors and keeping up? How do you think about that?
So, and it works both ways,
Okay.
right? There are people who reach out to us because we've been around doing this for quite some time. So, anybody who's starting in SaaS or AI, would potentially reach out to it. My partner Venkatesh. He leads that, and so his experience and just been around doing that for quite some time. People would reach out to him. Similarly, if you're trying to do something in consumer, I'm hoping that people will reach out to Anup or Mandeep, who looks at fintech. So there is a sector level focus that we have, and people who lead those sectors from an investment standpoint at the fund. Now, what I mean by that is, these people build those networks, the relationships, understanding of what's happening with that specific sector, because it's not possible for everyone to know everything that's happening across all the sectors. Right? So it's very, very focused in terms of building capability of understanding what is happening there, and so on, and then relationships, networks, and so on. So forth, right? So I think there is a very clear focus at a team level. In terms of so that's one. So people reach out to people here, and just because of the fact that we've been around, the equity that we have built in the market, right? The other one is also how we think about an inside out, saying that, okay, we think now is the right time to look at deep tech, for example. Right? We've been opportunistically looking at deep tech in the last many years, but I think given the gestation periods, the maturity of the market, we think this is the right time. And so there is a lot of prep work that happens at the fund with very specific focus on certain domains, certain sectors, where there is a lot of prep work that happens. And then we start reaching out to people to say, who else is doing what here? And so there is an inside out process as well, right? It's a little bit of a whiteboarding kind of a process. And then we figure out which is the best company, best founders. And then these are also, because it's also very tech heavy in some of these domains, we have help from people outside who help us evaluate the technology IP landscape, for example, because you don't want to be infringing. So there is a process in terms of how do we map competition in those, and where do we, rank these businesses, and which one is the best one to make the investment. So there is a very structured process. Like I said, this is evolved over the last 15, 18 years. And it's something that has yielded good results for us.
Not only from the in terms of deep tech, not only from the tech perspective, but also in terms of, do you also mean we will have a sufficient market in India itself? You think so?
Which is why we think today is a good time, because that earlier we didn't see some of these deep tech companies come up, but it's just that the markets are somewhere else. Today, government will be one of the largest buyers of some of these pieces of technology and product or service, right? Which is why we really think the local market support for deep tech will also go up. And then, given that there is so much of investments that are expected to come into the space, you will see a lot more companies starting up here. So it's going to be very, very different from what we've seen in the last 15 years, both in terms, all in terms of the quality of the capital that is coming in, and the founders and the product and businesses that will come out, and the VC ecosystem itself. I think, you'll see a lot more sophisticated folks coming in and doing the needful.
So once you've invested in a company, is there like a onboarding process? In the sense, what I'm trying to understand is like, one is like, how involved do you personally like to be? Is it more hands off? Is it more, you already spoke about like how there might be first time founders who might need some guidance, so that's part of it. But also earlier you also spoke about, ultimately you're running a fund, and every fund has a fund cycle, and then you will also have to return capital to the LPs. So is there like is there a talk where, after a point, we'll have to either divest, or we'll have to, there should be some exit strategy? Like, how do you talk about that? Is there a talk at all? Just trying to understand that
So
thinking.
I think, see, the founders have also gotten extremely sophisticated about their understanding about all of this over the last many years, right? So anybody who raises capital today understands that at some point there will be an exit for the investors. And see, just because somebody exits doesn't mean that the company stops working. A company has to be sold. There are different modes of exits that are possible and so on and so forth, right? But I think from a founder standpoint, I think anybody who raises capital, I think today understands that he will have to provide exits for the investors, whether it's the angel investor or early stage investors and so on and so forth, right? So I think that is very, very clear. In terms of at least my approach to founders, I think there is institutional process here, right, of onboarding and investment, right? I mean, we have a portfolio support, like I said, works with the founder in setting up some of these processes early on, because at the end of the day, the founders are very focused on building a product, building the business. Uh, they might not be understanding the nuances of, say, cash flows or P&L or balance sheets. These are all, not the first thing that comes to any of the founders' mind is he thinking of building the product, right? We are talking very, very early stage, right? So there's an institutional support in terms of how we put that process together. But I think outside of that, it is really their expectations are also extremely high today in terms of what VCs, what they expect of the VCs, right? It's no more that you turn up at the board meeting and, have a small discussion and then leave, right? Today they're saying, okay, what else can be done? Most founders have, one slide which says, this is what I expect from you. This is the introduction I would want. This is the guy I'm trying to hire. And, can you help here? And so those are, early stage that becomes important. Then when you think about fundraising, okay, how do we go about fundraising in the next round? What are the metrics that we need to track? How do we go about doing that? So those are at different stages. The involvement is slightly different, right? Very early, I think I speak to them almost on a weekly basis on what is happening. Is there going well? I mean, we look at the hire, are we on track, and so on and so forth, right? I mean, so yeah, and then as the relationship matures, and then you also have a sense of what the founder is capable of doing and stuff like that. I think those conversations change, right? It's also very important to understand one thing here. When we invest behind a founder, we are investing with the thesis that we think he or this is the team that is best equipped to build the product, the business, and so on and so forth, right? So it's very important to respect that and not cross the line and say, okay, I know what to do, you do this. So micromanaging is not something really that really works. It's important to say that, okay, we back the founder and respect that line and be, like I said, a sounding board. And being a founder is not easy, right? I mean, only the difficult things come to the founder. The rest is always solved by the rest of the team, right? And so helping him as a sounding board and it's very difficult for the founder to say, okay, sit to this team and say, I'm also struggling here, right? And so it's building that trust. I think I spend a lot of time trying to build trust with the founder, saying that, okay, we are on the same side here, right? And we can solve this together. Not that the approach is not that I have the answers, but together we can kind of solve for this.
Maybe a digression here, but is your thinking, is your firm's thinking as well that, every company you back should be like $1 billion business, because the economics might not work for the fund if it's not like that? Or do you approach it differently?
No, I think, see, every business that we back, we think it's going to become large. There's no reason why. If again, like I said, not every business is fundable, or not every business requires to raise capital, right? But if you raise capital, you need to scale, you need to build, because there is a certain time window for the business. As a fund who invests, we have a fund life, And so it's important to understand from founder's perspective also that if you raise money, you need to build a business that grows to a certain scale in a certain period of time and so on and so forth. Right? But from our side, we'd like to believe that every investment that we make goes on to become extremely large, because the economics is the fact that 70% of these companies do not make it.
70%, is it?
Okay. Again, in difference, it could vary different based on the vintage and so on and so forth of the markets and so. But majority of them do not make it. So the ones that really do well need to become really large for the economics to work and making sure that the returns are there, right? So, which is why I said that portfolio construct that we make in the beginning of the fund needs to balance this risk with the outcome, right? You don't want to be in a position where you've taken massive risks and all of them die, right? So you need to make that balance where you're taking enough risks, but you're also, building a portfolio that says that, okay, there is some mitigation to that.
I'm really sorry. I have one more digression. Feel free to skip this question. I've also seen companies which take funds from investors, and after a point, they return the funds because they just see that, it's maybe they figured out it's probably not a viable business, or maybe the initial thing that they were trying to solve is maybe it's very difficult, or they don't see the light at the end of the tunnel. Do you have any thoughts on that? Like, is that like...
No, that's exactly the reason I was saying this is a very hard business. Right? Raising a seed round is very easy, right? I mean, if you're fairly good pedigree and you smart folks, but you can raise a small amount of capital, right? The real difficulty is building a business, right? And that starts to appear as you reach Series A, Series B. I think it becomes very, very clear. That's when the hypothesis that you make or you've made in the beginning is really challenged, right? Maybe it's not working out. The product market fit is just not there, right? The unit economics does not seem to be working, right? You could have a situation where the team that you started with is not aligned anymore, right? And holding on to talent becomes a challenge. So we've seen all of this play out, right? And we've also seen, like you said, where founders have realized that this is not working. And do we pivot into something else and do the needful? Do we have the ability to do that? Do we have enough capital in the bank to make those changes? And if that is not the case, what's the best option, right? Do we return the capital, start all over again? I mean, so those are options in front of founders, and some of them have exercised that. And I think I think it's also maturing of the way the founders think in terms of what to do with their time, because at the end of the day, their biggest resource that they have is the time and the opportunity cost that they're after, right? So when do they cut the rope and say, okay, let me figure out something else, is a conversation.
So there are a couple of threads. I'll just lay it on the table and maybe you can pick and choose what you want to pick. So one trend which many people have kind of spoken about is companies which were either listed or incorporated in the US or Singapore, they're coming back to India. So that is one thread. But also in terms of exits, my understanding is like secondaries is like the most dominant form of liquidity for venture firms. Are you happy with that trend? Is that trend changing? Am I wrong? Do you want to speak a little bit about how you are looking at exits? What is the state of exits right now? And maybe take that.
Sure. No, like I said, I mean, it's one of the most important engines that need to fire for the success of a venture firm, that we also have a exit engine, right? Not just about making exciting investments, right? Because making an investment, all said and done, is one part of the business is easier compared to saying how do we figure out exits and making sure returns happen, especially when we talk about early stage, right? Now, the exit landscape has also significantly changed in the last 15, 20 years. Today, we are seeing companies that are going IPO, right? Now, what is interesting is that some of these companies have taken 12, 13 years, right, to go through IPOs. Another interesting phenomena is today we are also seeing companies that are starting and going to an IPO within the life of the same fund. It's an amazing situation to be in, right?
Just to be clear, you're talking about they're going to IPO in the span of 6 to 7 years. Is that fair?
Yeah, maybe a little bit more, but yeah, right. But within the 10-year time frame, right? And that is a significant shift, and we expect, this IPO market, but at this point in time. But I think IPOs as a form of exit has truly come about in the last 5-6 years, which has never been the case earlier when we started the business. So for us, if you think we expect secondaries, you mentioned secondaries continue to be a significant portion of exit for most funds, right? Now this could happen when companies raising their later stage rounds, you get an exit, or you could be there are a lot of secondary funds, now continuation vehicles. There are multiple modes of secondaries that today is a very, very strong and a viable option, right? M&As now, we have seen 20 plus M&As in our own portfolio. Okay. Flipkart was acquired, Indra was acquired by Flipkart. Flipkart themselves went through a bit with Walmart and so on. So, right, Cisco was acquired, CloudCherry. So we've seen Play Simple got acquired in the gaming side. So we've seen a bunch of M&As, right, big and small. However, those are, there's a lot more work that needs to be done from an M&A standpoint, because there are no domestic buyers for some of these companies, and you'll have to think about how you will build that muscle. And which is why we've, and I mentioned this earlier about how we've made deliberate investments in around exits, and we have a small team that focuses only on exits.
Sorry to cut you off, but is there an impact on returns per se that you prefer, I don't know, IPO route than they're all?
No, I think, see, not every company is built for an IPO. Not every company can go through an IPO process, right? So again, these are things when we make the investments very, I mean, some of them will be clear at some point in time, but the journey of the company, it will be very clear, saying that, okay, this is a company which is very, very tech heavy, IP led. Will find, mm, IPO might not be the best way to go forward, right? Because the founder might be founder team, and the team that the company has will be very, very focused around how do we build innovative product, but not so much, the strength will not be on the distribution side. So, I mean, having somebody with significant distribution muscle can become a very, very good partner here, right? So I think there are different companies that go through different journeys, and those journeys define as to what kind of potential exit route is the best, right? There are companies that take significantly longer, right? Which is why as the company raises the Series D or later stage rounds, we will have to exit because the fund life is a constraint. If the company continues to build, because the gestation period for that could be much longer. So that the journey that the company has, the kind of company that we are backing, will define the exit.
So no conversation can probably happen today without discussing AI. Just wanted to know your thoughts on how are you thinking? How are you thinking about it? There is a lot of investment being made. I don't know about India per se, but at least in the US, it seems like everybody is making like billions of dollars of investment into data centers, into energy, into foundation models. So are we seeing like a flurry of activity in India as well? Also maybe in the startup space, because most of the investment, at least we see in the news, are mostly from like big tech, like FANG companies per se. Uh, what is the investment landscape like in India as with respect to AI?
No, I think, see, I mean, AI is really a transformation. I think there is global consensus today that AI is a transformational piece of technology. I think there's no question about it. We've seen some of these transformational pieces of technology. I'll give you some examples here, right? The internet was one, right? I think it took some time, but then look at the number of businesses that were built on the internet, and it really changed the way people consume information, right? Mobile was another very, very strong wave that came up and really transformed how people consume technology itself. Yeah, right. Today we have AI, which I think is changing the technology landscape itself, and I really think we are in the very early stages of of AI, both in terms of building and deployment. It is still early stage, and if you really look at it, there are multiple. The AI stack has data, they have compute, the models that you spoke about, and the applications. I mean, depending on where you are, will define the amount of capital that you will need.
Yeah.
And how you go about building. In India, we are seeing a lot more of applied AI. I mean, there's not so much investments from a startup perspective into models, and so we're not seeing that.
Yeah.
Right. What is interesting is that you see the model companies are moving into applications. If you look at globally what's happening, like the model companies are moving into applications. They're also going and saying that I'm going to invest in building my own chips, data centers. So there's a lot of, it is very early days for everybody in this ecosystem, right? But fundamentally, right, the way we think about this is what are you building using AI that can be very useful and can also be used by large enterprises. And that's really the moat. I mean, if you are able to build anything, even at the application layer, right, but you are building something that can work with the rest of the systems within the enterprise, those are really what we are looking at. And then, vertical domain, domain specific AI, all of that becomes critical when we look at AI. But very, very early days, Ryan. From Fund 5, we think about 30-40% of our investments will go into AI companies. And then AI, again, AI is very broad-based when you think about it, but it can be applied in healthcare, it can be applied in fintech, we're also seeing consumer applications, and that's the significant change compared to any of the other pieces of technology that we have seen. The adoption is both from top down as well as from consumer up, and that's really transformational if you're anything.
Do you what are your personal uses of AI applications that may or may not have helped you in your daily workflow, if at all?
I mean, the way we consume technology, information has significantly search has moved from Google to that we are using ChatGPT or Claude or Perplexity or whichever, right? I think that has been a very significant change. We are actually at the fund level deploying, building small agents to figure out how we can better optimize our decision making and reflect on the decisions that we've made at an IC level, whether it's doing well or not well. Do we need to reflect upon on the decisions that we've made? We work with over 120 plus companies in terms of the information flow that comes. How do we navigate that to help ourselves understand these businesses better? But also the fact that, if we have a bunch of companies in consumer, for example, when we meet a new consumer company, we can figure out what is the data that we need to look at. And when we invest into a new company, what are the KPIs that we need to build? And then also how we can leverage AI to help our investors that we raise money from understand the data that we are sending them. So I think that is absolutely there and is going to only increase in terms of our consumption of AI tools to help both in terms of productivity and also entertainment and everything else, right? Today, it's funny, but I enjoy, chatting with an agent, trying to figure out, okay, what do you think I should be doing on some things? And even though I know it's an agent on the other side, but I do enjoy sometimes chatting with some of these agents.
It's a major use case, yeah. Yeah. Yeah.
If you really think about from an enterprise standpoint, we've had some of these technologies come by, cloud, SaaS, but AI is slightly different. And I'll give you an example of healthcare systems. There was this graph that I very recently saw somewhere. Adoption of workflow systems and EMRs in healthcare took about 15 years to reach 80-85% levels of adoption. I'm taking the US. This is moving from paper and pen to workflow systems, digital EMR, digital, and so on and so forth, right? Today, if you look at medical scribing that doctors use, which is an AI system that doctors use, it's reached there in 2 years adoption, right? And this is really the difference when you think about the current AI systems to what your SaaS and cloud-based transformation that enterprises are still navigating through. The adoption is high because I think even at personal level, we are very comfortable using this. I think that is what is really, that's one piece that is driving this adoption. The second one is, nowhere in, in the recent history have, even if you look at the transcripts of quarterly calls of listed companies, there are analyst investors asking, what are you doing about AI? So it's a very huge top-down push in terms of wanting to do somewhere for large enterprises. So both from the end user individual perspective, you are using more and more and you're comfortable, and there is also a significant push from the top at an enterprise level to use some of these. So I think that is what is driving this excitement about AI. But it's still early, very very early days.
Could you also touch upon what are the LP expectations that you might have when you are raising capital from domestic investors versus international institutions per se? What are the expectations, differing expectations that you might see, and what is that process like? And if you can shed some light, it would be useful.
Yeah, so I think as a fund, we've raised close to $500 million from the domestic market, right? And this is something that we started in 2000. This process was started in 2012, 2013. And at that point in time, I think a lot of people laughed at us, saying that domestic investors will not understand this asset class because it's very very new, right? It continues to remain a fairly new asset class for domestic investors, right? Having said that, we have raised $500 million, and there's a difference in the
$500 million or $500 million? $500 million.
$500 million. That's right. Yeah, $500 million, right? The international investors are fairly sophisticated in their understanding of this asset class. They've been doing this for many years across the global markets, right? They understand that the timelines in building out a portfolio companies, how long it takes to build companies, illiquidity nature of this asset class. All of this is fairly understood, and then they are also many years have kind of built a portfolio construct for themselves as to what risk they should take within this asset class, because there's VC, there's PE, there is the multiple kinds of opportunities that are there. When you come to domestic investors, like I said, very very new, and so they are also going through a journey of discovering this as an asset class. While there is a lot of excitement about new things, new companies, new technologies, the mortality rate, the fact that you will be illiquid for 10 years or so, capital locked in for that period of time, the risks associated with companies dying, all of this is really people are really going through that learning curve. This is when we started in 2013 or so, and today it's significantly better, right? And we've also seen some of the large family offices set up funds structures by themselves to make direct investment. Now it's wonderful if you think about then capital coming in. We will also have to think as to do they have invested in putting up a process team and so on and so forth to making sure that this is successful, right? So that I think is a significant change from where you think about domestic as well as offshore investors.
Sorry, if I can just go back, but why do you think it's significantly better? Is it because in the last decade or so, Indians themselves have gotten richer? Is there a lot of money inside India itself, or is it PR that they have seen a lot of, I don't know, success from Indian startups, and that's why they also are interested in participating in that? What do you ascribe that?
No, I think the reason we looked at the domestic LP base is the following. See, if you study the China market, right, domestic capital in China plays a very significant role, right? And so there is no reason to believe that Indian investors should also participate in the growth of the startup ecosystem in India. I think that's really the hypothesis with which we started. So it's not the fact that there's a lot of money. I think there is significant amount of capital that is available in India. It is just that alternate assets such as VC and PE are not being fairly explored by these investors. And today, like I said, the sophistication is high. They're setting up family offices that can look at alternate assets in a more structured format. So capital has always been there, and we felt that deploying that capital or attracting that capital into the startup ecosystem will help both, right? And I'll tell you how, right? One of the things that international investors don't bring is the understanding of the local ecosystem. Okay, if you're a large LP from the US, their understanding of India will be fairly limited to what they're reading and brush with, right? That's not the case with the domestic investor. His understanding of what it takes to build a business here is very, very high. And of course, he's made that money building some business from scratch over the last many years. So if you are able to tap into that capital as well as the ability to help the founder who's trying to build here, right? I think it's significantly valuable. Now, which is why we raise money for both from offshore as well as domestic investors. And when you raise monies from this set, for the domestic investor, there is significant comfort from the fact that he takes that there are international investors here. So, your compliance, regulatory frameworks, process, everything is fairly very, very well set. And he takes a lot of comfort from that, right? For the international investor, he takes comfort from the fact that the local guys are backing these folks, right? Because they're sitting far away, right? And trying to make an investment here. He takes a lot of comfort from the fact that there is domestic capital supporting this. So there is a win-win for both, which is what we've seen work very, very beautifully for the investors in our LP base.
I don't know if you have the data for this, but in general, like in today's time, like most of the capital that is invested, is that mostly from international investors, or is
That's international, because the largest pools of capital are outside the country, right? And that will continue to remain for some time. So there's no question about that. It is larger pools of capital, more sophisticated pools of capital. But I think, over the many years, you will also see that this pool of capital that's coming here from Indian investors will also increase. And their sophistication as
2-3 decades?
No.
You don't think so?
No, it's faster, really much faster.
Okay.
Much faster. 3 decades is very far away, my friend.
Just to, I don't know again if you update on this, but is it mostly US institutions that take part, or is it Middle East, or?
No, US, we've raised capital from Europe, Japan, Southeast Asia. So it's fairly global phenomenon. Like I said, India is the third largest startup ecosystem. So there is, people across the world who are interested and want to participate in the growth. So we're raising money from everywhere.
Is there more paranoia from domestic investors in terms of, like, I don't know, a risk appetite per se? No?
No, I think, like I said, it's an early, it's very early for them in terms of their understanding of this asset class.
Okay.
Right?
Yeah, does that foster paranoia? Because this may not be.
It's always, they approach it skeptically.
Okay.
Right? And like I said, it takes time.
Do you have to do any hand-holding per se like that, or calming?
No, I think, see, the conversations are a lot more, right? They reach out to us a lot more, and then our conversations a lot more often compared to an international investor. We have quarterly calls, we have, all of that we do, but, and also the fact that they're closer to us, right, from a proximity standpoint. And they also want to genuinely be involved. So, because these are also, you have to understand, these are operator families, right? People who build businesses, so they also want to kind of give back and want to be involved a little bit more. So I think there is a balance, which will happen over a period of time as they also understand what is needed to be done, as what's the role that an LP plays versus what a role a GB plays, right? That as that sophistication happens, you will see a lot more balance in this.
How do you expect the venture landscape to kind of evolve in the next decade or so? We spoke about 3 decades is a long time, but maybe if we can look back for 5 to 10 years, maybe.
No, I think, see, there'll be a lot more capital flowing in. I think that
Domestically, internationally, both. Okay.
Into this asset class, right? Both in terms of offshore capital as well as domestic capital. I think there is, and India requires that also, right? The capital requirements for good companies only increasing, right? So you will see a lot more capital flowing in. So that, I think, is one significant change that we will see. Like I said, exits have always been a challenge in the last 10 years, and that is opening up significantly across secondaries, M&As, and IPOs like we spoke about. You'll see that also significantly change. We are also seeing, companies that are starting from here. The gap between the companies that are starting from here and the companies in the US also closing.
What does that mean?
That means is, 10 years back, if you found a software company here, you would already see there are about 15, 20 companies in the US, of which 5 of them have raised significant amount of capital. Right now, we're seeing companies that are starting here that are not too far away from a time perspective from the companies in the US. So that I think that is definitely shrinking, which basically means that there's a certain level of closing down of that gap. Of course, the markets continue to remain
In the
very, very deep there.
Okay.
Right. Tech talent is extremely high. Supply chain of capital is significantly high there. So those are continue to remain. But the fact that when somebody starts here, it's not too far away from a thought process to somebody sitting in the US. I think that is definitely there. The other piece we also believe, which is why our focus on deep tech in 1.5 is a little bit more higher, is that the time for deep tech in India. Right, 2-3 strong reasons. I think there's significant push from the government in terms of backing technologies that are futuristic. They are setting up a fund called RDI, which is really going to back both at a company level as well as funds who are going to deploy capital in deep tech. So I think, and then there is also the geopolitical issues that are there, whether it is space, whether it is we're talking quantum, semiconductors. I mean, these are all new areas that you will see a lot more stuff happen in India. And so that I think is a very, very significant change from just being services to a product landscape that we've seen so far.
Do you have like a book recommendation, or I don't know, is there that you would like to share or something like that? I don't know.
Yeah, one book that I go back, at least some portions of it that I read every year is this book called Power of Habits. I think it's for the longest time I really thought that some things come very naturally to people. Came as a revelation to me that people can actually work towards reaching developing skills, just effort and small habits. So I'm a very big fan of that book.
Is there a habit that you've developed because of that book, or it's consistently managed?
No, one I'm trying to do is trying to make sure that my email box is zero.
Okay. That's a hard one. Okay.
Yeah, that's something that is work in progress.
I think on that note, Ranjith, thank you so much for taking the time. Really appreciate it. Thank you.
Thank you very much, and good to have you here, and really appreciate you having me on the.
Oh, my pleasure. My pleasure. Thank you so much.